If you've ever thought the key to being a successful trader is just finding that one perfect magical strategy, you are definitely not alone. But today, we're going to pull back the curtain on a secret that is so much more important. It's the thing that really separates the pros from everyone else.
Just let that sink in for a second. Read it again. Most traders don't fail because their strategy is bad. They fail because they trade the wrong size. It's not always that your analysis was off or your entry point was a little late. The single biggest reason traders blow up their accounts comes down to this one thing: how much money you put on the line for any single trade.
So, if trading the wrong size is the big, scary monster under the bed, what's the solution? Well, it's not another fancy indicator or some new chart pattern. Nope. The solution is all about building a defense. Think of it like a financial shield that protects you from the wild swings of the market, and maybe even more importantly, from yourself. And that shield, it has a name: position sizing. It's really just the simple act of deciding how much of your capital you're going to put into one single trade. If you get this part right, even a kind of mediocre strategy can keep you in the game for the long haul. But if you get it wrong, the best strategy on the planet will not be enough to save you. Okay, this brings us to what is, without a doubt, the single most important takeaway from this entire explainer. Seriously, if you forget everything else, just remember what's coming next. This is the absolute bedrock of professional trading. It's the rule that governs survival. And here it is: 1 to 2%. That's it. This is the golden rule. You should never risk more than 1 or 2% of your total account on any single trade. I know what you're thinking. That sounds way too small, right? Too conservative. But trust me, its power is absolutely immense. Let's make this super real for a second. Let's say you have a $1,000 account. That 1% rule means the maximum amount of money you are allowed to lose on any one trade is just 10 bucks. That's it. This isn't about limiting how much you can win. It's all about making sure that no single bad trade can ever knock you out of the game. But why? Why is this tiny little number the key to everything? Well, it's because it builds this incredibly powerful defensive system around your entire account. Sticking to this discipline does 4 absolutely critical things for you. First, and most obviously, it protects your capital, which is your lifeblood in the market. Second, it keeps your emotions in check. I mean, when you know the absolute most you can lose is just $10, that crippling fear and greed that cause terrible decisions, they just shrink. Third, it lets you survive losing streaks, which, by the way, are going to happen. You could be wrong 10 times in a row and you've only lost 10% of your account. You're still in the game. And finally, it forces you to be consistent. And consistency is the hallmark of every single successful trader out there. So knowing the rule is one thing, but it's just as important to recognize the common traps that so many traders fall into when they ignore it. Let's look at the mistakes and, of course, the simple fix. Do any of these look a little familiar? Going all in on what feels like a sure thing? Or maybe just picking a position size totally at random because it feels right? Oh, and the classic, doubling down after a loss to try and win it all back fast? That's called revenge trading. All of these are just symptoms of the same problem: a total lack of a disciplined position sizing strategy. They're emotional gut reactions, not logical decisions. Okay, so we've talked a lot about the problem. We know the what and the why. But how do you actually do it? How do you practically calculate the correct size for every single trade you make? Believe it or not, it's this simple formula right here. You just take your risk amount, that's the 1% we talked about, and you divide it by your stop loss. And your stop loss is just the distance from where you get in the trade to where you've decided you'll get out if it goes against you. The number you get is your exact position size. That's how you turn this rule into a real-world action. And hey, don't worry, you don't need to be some kind of math wizard to do this. There are tons of free position sizing calculators all over the internet, so the tool itself isn't the challenge. The real challenge is having the discipline to actually use it every single time. All right, let's start to wrap this up by shifting our perspective a little bit, because this isn't just about a formula or a rule. This is about adopting a completely different mindset. It's about thinking like a professional. This right here is the core of it all. It's the professional mindset in a nutshell. Amateurs are obsessed with how much they can win on a trade. Professionals, on the other hand, are obsessed with how little they can lose. Their number one job isn't to make money, it's to protect the capital they already have. The profit? That's just a byproduct of playing great defense and staying in the game long enough for your strategy to work. So I'll just leave you with this one question. The next time you're about to place a trade, stop and ask yourself, am I making this decision to chase a quick profit, or is this decision designed to ensure my long-term survival in the market? The answer to that question, well, it's going to tell you everything you need to know.